talk more broadly about the markets, bring in our next guest, Ted Thatcher, joining us this morning, president at Bright Lake Wealth Management. Ted, great to have you with us. Great to see you as always. Let's take a look at the market action happening this morning. Pretty significant move to the downside. What are your thoughts on how we're starting the week?
Marley, we're seeing a little bit of red this morning. The market continues to digest the largest infrastructure build out in human history. We've seen the number cited time and time again now, $600 billion in AI CapEx spend by the hyperscalers. You're seeing it in the NASDAQ this morning. The numbers are down. Really, the way I'm looking at this is twofold. Firstly, the street is trying to figure out how the fundamentals make sense here. It's trying to figure out how we're going to get that ROI out of all of this spend. And then secondarily, on the human side, the street is trying to process how this is going to affect the workforce. How is it going to affect blue-collar workers? How is it going to affect white-collar workers? We've seen all the headlines the last couple of weeks. Some of these accelerated projections show white-collar work completely disappearing in the next, 18 months, with robotics, close to follow behind it, knocking out the blue-collar worker. And so this narrative discussion has become, hey, are we going to see the productivity gains from AI first, or are we actually going to see a lot of displacement?
And, even so, with all this data that we've gotten and this market action we're seeing this week, you say that the economy is holding up better than feared, but we're still seeing all of this uneasiness, Ted. What are your thoughts around that?
Yeah, when I look at the actual economic vital signs, Marley, there's been so much narrative and discussion around the labor market. Hey, are we going to just keep seeing unemployment tick up, up, up? Obviously, we got a 4.3 print on unemployment. That seems to be headed in the right direction. Of course, inflation has been sticky, but we are seeing trends in the right direction on that front as well. I think that there had been a lot of hope on the GDP side, especially with that projected number of, I think, a 5 handle for the fourth quarter. That has gotten knocked down to 1.4%, notably caused by a number of things, but I would say perhaps most notably a decrease actually in government spending. But the reason I'm not as concerned about the GDP specifically, and I think this is actually a little bit underreported, is that $600 billion number that we keep talking about. If you look at that and how it affects GDP broadly, it is literally a 2% tailwind to GDP in 2026. And so on the economic vital signs standpoint, I am hopeful for the year still.
So do you think that $600 billion in CapEx for 2026, that the markets are underestimating how stimulative that could be for GDP? Is that what you're saying, Ted?
Yeah, absolutely. It is a shot in the arm when it comes to the economy, especially as we do see some government spending come down. And, obviously, when we think about where the investor sits today, we can just kind of follow the money. We see a lot of the, I'll say, more boring sectors of the economy, consumer staples, materials, energy, all have performed really well, double-digit returns so far year to date. And it puts those, I think, in a really interesting situation, actually. They're now trading at 25 times earnings, I think, consumer staples broadly. And then you compare that, of course, to the mega caps, and we start to say, okay, well, where do investors go from here?
And so as we look at that, investors keep questioning this AI ROI. We keep having this conversation about we're in the show me section now of the game. At what point do we really need to start seeing productivity gains across the board with this massive spend, not just in some of the spenders, but in all of them, rather than just keep spending here?
At the end of the day, the street is going to operate fundamentally on what it can get in terms of ROI. Shareholders have to see a return. And so I think that is really where the narrative and conversation has gone now, and why we've seen the hits we have on these hyperscalers. So, while it hasn't been produced yet, to your point, I think some of the companies, I think perhaps most notably Meta, has really started to turn an ROI on its use of AI. But, if I could pick out a couple names here, Microsoft and Amazon specifically, I think that they have done maybe not a disservice, but I'll say a disservice to shareholders in some of the narratives that have come out of earnings season here. We got to remember, Microsoft owns 27% of OpenAI, and Amazon owns 17% of Anthropic. And so, yes, the CapEx is much higher than expected, but the same narrative that of the AI future is sort of fighting this narrative of overspend. And so I think that they also should be getting credit for those stories as well. And with where they are from a pricing standpoint, price to earnings compared to historical averages, I think it does present a potential opportunity for investors right now.
So you're bullish on Amazon because of this underappreciated relationship and its AI positioning here. What additional part of the story for Amazon do you think makes them so appealing? And I guess I want to follow that up with, how do you view Amazon? Is Amazon still a growth stock, or is it amid a transition?
I think that Amazon has gotten questioned for several reasons. Obviously, we've talked about the expenses and how much they've put, into CapEx. But there's also this other narrative in the AI story that is now a question of, hey, is it going to make more sense for us to operate AI through AWS sort of remotely? So much has been made of cloud computing, and it's made business so much easier to just do cloud. And now there's this question of, hey, should we all have, some on-prem, hardware to be able to locally run these AI models for data security reasons? And so I think they are fighting that. I believe that that Amazon will come out of that, actually, and they'll be able to still employ AWS in an incredible way. So that's been a huge driver of growth, of the overall growth story for Amazon. But I do look at it on two sides. Of course, the compute side, and also on the robotics side. Amazon is a logistics company, and they have over 1 million robots in their, distribution centers. And so I think that they are going to be that company that hits the singularity first of more robots sort of working for them than employees. And with all of the technology that's coming to bear in that realm, I actually am really bullish on Amazon. Again, especially at this current price point. So much of the last several years, we've had this narrative that consumers can't get access to the market at low multiples. And now with everything kind of dropping down, $1.5 trillion having been lost in market cap on the hyperscalers, I think it might present an opportunity to buy.
All right, and let's stay in this mega cap conversation, because you brought up a really interesting point about Apple in this conversation, that Apple is actually being rewarded for not overspending on AI, when we've seen some be punished for spending and some be punished for not spending enough. Apple seems to be rewarded. Is AI capital discipline a new narrative that we need to look out for, Ted?
Absolutely. Of course, if the street is looking at fundamentals, and it can have a story with Apple Computers, who has created, one of the most incredible products. The amount of pieces in sourcing that has to go into creating just one iPhone is absolutely astronomical. It's an incredible moat. And so it's no surprise to me that that is being rewarded on the street right now. Maybe it is not the hyperscaler growth story, but it is a safe story. Again, watch the money flow, right? So much has gone toward the sectors I mentioned before: consumer staples, materials, and energy. Apple's another version of that, just in a different light, still in the mega cap side, but because of its discipline with its capital. It's gone to the, buybacks and tons of dividends to shareholders, and right now it's absolutely paying off for them.
Well, Ted, we really appreciate you taking the time to be with us this morning. Always great to have you on the show. Ted Thatcher, president at Bright Lake Wealth Management.